and welcome to another session of the Rousseau Report, sponsored by AircraftPost, the global leader in market intelligence for business jets. I'm your host, Dennis Rousseau. Before we get started, today I'd like to provide a little background. In the 1970s, I joined a company that was not only the innovator of the condensed version of the cardiac pacemaker, but also the innovator of fractional sales. The company was Intermedics, and the founder and innovator was Albert Boydell. The concept was quite simple. Strategically stage 5 twin-engine helicopters along the Gulf Coast and provide EMS, or emergency medical services, to the offshore oil rigs, something that hadn't been done before. The helicopters were equipped for EMS only and were paid for by the oil companies. However, as opposed to selling them the whole helicopter, they purchased a piece, or a share, typically 25%, which would provide them 24/7 coverage when needed. And not only was the business aviation market in its infancy, so was offshore oil drilling. And workers were getting injured and needed immediate care. Unfortunately, in the early stages of formation, Albert and his pilot were killed in a helicopter accident, which obviously ended the venture. However, the fractional concept was born. Those are exponents. Investment? That's a frickin' sawed-off nose. There we go. Fractional aircraft ownership has come a long way over the years. You name the business jet, and it's probably offered in a share program. Lears, Hawkers, Citation XLs, Sovereigns, Citation 10s, Falcon 2000s, Challengers, Gulfstreams, Globals. Have I left anything out? Over the last year, these programs have experienced exponential growth. Why? Is it due to the pandemic? Pent-up demand? Deteriorating commercial service? Share programs are ideal for people that want to own an airplane and have a 50-plus hour per year requirement. They enable you to buy flight time on a business jet that you share with other owners, which eliminates the capital outlay required to purchase an aircraft on your own. Or does it? Today, we're going to talk fractionals. Not contractual terms or free hours or warranties, anything else. There are many companies that specialize in just that, but few that address residual values and resale. And keep in mind, this is a large capital outlay. But first, a few benefits to the programs. They allow you access to a whole fleet of aircraft, where a participant can use any aircraft in the program. By way of example, if you own a share in a Lear 75, you also have access to aircraft in the super midsize category, such as the Challenger 350, as well as the ultra-long range G650. Obviously, they're subject to availability, and you only pay for the hours you fly. There's no charge for waiting time or deadhead and crew overnights, unlike when you charter. You don't have to worry about a crew member getting sick or one being off at training. Now, just a side note, aircraft ownership is not for everyone. If you fly under 25 hours a year, charter. 50 to 150, fractional ownership. Anything over that, it may make sense to buy your own aircraft. Each fractional company has its own terms and conditions. However, for the most part, they have similar operating principles and in some cases, operate the same aircraft. By way of example, NetJets, FlexJet, and AirShare. They all operate Phenom 300s, 145 of them, and this represents 22% of the 647 in service. Let's move up to the super midsize category, where NetJets, FlexJet, and Vista Global combined operate 191 Challenger 350s of the 852 in service, again representing 22% of the fleet. Now keep these percentages in mind because they become very important, which I'll show you in a minute. When we look at other current generation aircraft, such as the Legacy 450 and Citation Latitude, 38 and 54% of the fleet respectively. The Citation Longitude that entered service only 2 years ago, 56 in service thus far, and NetJets operates 30 or 54% of the fleet. Now obviously that dynamic will change over time. When we move into the ultra-long range, VistaJet and NetJet operate 20% of the Global 6000 fleet. The 7,000-mile Global 7500 is making inroads on the fractional and charter markets. It's too early to determine how many will be purchased, but the order books are filling up. Now, before we get into residuals, let's take a look at capital outlay over a 5-year term. Please keep in mind this example is for an aircraft that's no longer in production nor available in a fractional program, and the costs which were representative of a Falcon 2000 in 1999 are for illustration only. A comparable aircraft today would put the ACE share at $4.5 million. So again, the numbers are dated and used for illustration only. Based on an ACE share, the acquisition cost was $2.8 million. Then there's a $17,000 monthly management fee, $2,400 charge for each occupied hour, bringing the annual outlay to $1 million or $10,000 per hour. And that excludes market depreciation, and that's where we're going with all this. But first, a primer. The operating time for a fractional aircraft is usually based on 800 hours a year. In other words, operators expect the aircraft to be flying 800 occupied hours per year. Although with repositioning, they typically fly closer to 1,200, which means you're going to need 5 to 6 pilots per aircraft for all that flying. So if you consider an average fractional aircraft, it will have 12,000 hours after 10 years, compared to corporate operators that may fly between 300 and 500 hours a year by the same flight crew, and after 10 years, well, you do the math. At the end of the program's 5-year term, owners usually sell their share back to the operating company for fair market value. This sale price is dictated by the market, specifically resale values when compared to a mainstream aircraft. Now let's take a look at what happened in a particular case. 256 G200s were built over 12 years starting in 1999. A fractional provider acquired 38 of them, or 15% of the fleet. In 2014, they struck a deal with an OEM where they would commit to X super midsize aircraft with stipulation they take 25 of the G200s in trade. This is what happened using 2002 vintage aircraft. The mainstream aircraft with 6,000 hours that should have sold for north of $5 million ended up selling for $3.6 million, or $150,000 more than the 11,000 hour due to the pressure placed on the pre-owned markets by the lower-priced fractional aircraft. And in 2016, 16% of the fleet, or 42 G200s, were on the market. It was a bloodbath. Potential buyers would use the pricing of the fractional aircraft against mainstream, and that just drove the price into the ground. So as not to pick on any particular make model, let's look at a Sovereign. 349 in service, 46 fractional, and this is what happens after 15 years. The fractional Sovereign is selling for 50% less than the mainstream. So what's happening with fractionals today, and how is the industry addressing these high-time aircraft to avoid a repeat of the G200 scenario? If we use the Citation 10 as an example, the aircraft are being traded in, then refurbished and placed in charter service, which makes all the sense in the world, as they're not destroying mainstream markets. Speaking of which, and one other point to address, and you've heard me say this in previous sessions, regardless of the make model, aircraft are depreciating assets. Every part on an airplane has an expiration date stamped on it, and good, bad, or indifferent, they lose value as a result. Many times fractional owners come to me and want a valuation on their ACE share. First off, my company doesn't do that. We value whole aircraft, and whether you're in fractional markets or purchasing a pre-owned business jet, you need to know the market. And that's part and parcel what we do to eliminate surprises. You know what you have going in, and you're all excited. And coming out the other end come time of resale. By way of example, let's look at Global 6000 markets rather. Very capable, comfortable, long-range aircraft that sells new in the neighborhood of 45 to 50 million. The aircraft comes standard equipped with many things that used to be optional. Today, the options lists have shrunk. But still, we're dealing with business jets, and everything is expensive. You want the best high-speed connection available? Be ready to spend $500,000 plus. More video monitors? $100,000. But come time of resale, these items will probably be obsolete, and you get nothing in return. Let's take a look at the pre-owned market now. After only 5 years, the aircraft lost, this is Global 6000 now, 50% of its original cost new. And it's not just this model. They all suffer comparable depreciation in a relatively short period of time, then level out somewhat over the ensuing 10 to 15 years. Buyer beware? Not really. This is the business jet market, and you will pay to play. To avoid surprises, have as much information at hand as possible to enable well-informed decisions. Call AircraftPost. They have the answers you need for strategic planning. Until next time, I'm Dennis Rousseau with the Rousseau Report. Now let's get on our latitude and get the hell out of here. Thank you for viewing. We'll see you next time.